All right, let's talk about something that's on a lot of people's minds, finding a little bit of safety and predictability for your retirement money. Today, we're going to demystify fixed annuities, a tool that's all about protecting what you've saved and maybe even creating an income you can count on. So let's dive right in. Here's the game plan. We'll kick things off with the absolute basics. Then we'll look at the different kinds out there, some for growth, some for income. After that, we'll get real about the pros and cons, the trade-offs. And finally, we'll help you figure out if one of these could actually make sense for you. So first things first, what in the world is a fixed annuity? Let's get to the heart of what it promises. I mean, does this question hit home for you? With the market going up and down like a yo-yo, it's totally normal to look for some kind of a safe harbor. Especially when retirement is getting closer, this is the exact feeling that fixed annuities were designed to address. Okay, so here's the absolute key thing to remember. A fixed annuity is an insurance contract. It's not sold by a bank, it's not a CD, so it's not FDIC insured. The guarantees, they're backed by the insurance company itself, which is why its financial strength is so important. At the end of the day, a fixed annuity really boils down to three big promises. First, your money is shielded from market losses. No sleepless nights worrying about a crash. Second, it grows in a predictable way, and, this is a big one, it's tax deferred. That just means you don't pay taxes on the interest each year. It gets to compound and grow, and you only pay tax when you take it out. And third, you can turn it into a guaranteed paycheck that you literally cannot outlive. So, how does this actually work? Well, it's basically a two-part story. First, you've got the accumulation phase. That's when your money is just sitting there, growing, totally protected from the market. Then, whenever you're ready, you can flip the switch to the income phase. This is when you turn that pile of money into a steady stream of payments, kind of like creating your own personal pension. Okay, let's build on that. Because not all fixed annuities are created equal. Some are built specifically for safe growth. Think of them as powerful alternatives to the savings accounts you might be used to. First up is something called a multi-year guaranteed annuity, or as people in the know call it, a MYGA. The easiest way to think about this is like a bank CD on steroids. You get a locked-in, guaranteed interest rate for a specific number of years, maybe 3, 5, or even 7 years. Now, this is where it gets really interesting when you compare a MYGA to a CD. Yeah, MYGAs usually offer higher interest rates, which is great, but the real kicker is the tax treatment. With a CD, you get a tax bill on your interest every single year. With a MYGA, that growth is tax deferred. Your money gets to compound without that yearly tax drag, which can make a huge difference over time. But what if you're thinking, I'd like a little more growth potential, but I just can't stomach the risk of the stock market? Well, for that, there's the fixed indexed annuity, or FIA. It's this really unique hybrid that links your growth to a market index, but, and this is the magic part, without putting your original investment at risk. And this slide just lays out the trade-off perfectly. With an FIA, if a market index like the S&P 500 goes up, you get to participate in some of that growth, up to a limit called a cap. But if the market tanks, your principal is 100% safe. You just get a 0 for that year, no losses. So you get a taste of the market's upside with absolutely none of the downside risk. Okay, so we've talked about growth, but what about income? I mean, that's the whole point of saving for retirement, right? This next group of annuities is all about turning your nest egg into a reliable paycheck. The most direct way to do this is with a SPIA, a single premium immediate annuity. It's exactly what it sounds like. You give an insurance company a single lump sum of money, and boom, they immediately start sending you a check every single month for as long as you live. Yep, it's really that straightforward. Now, a deferred income annuity, or DIA, is a slightly different animal. With this, you give them a premium today, but the income stream doesn't start for a while, maybe 10 or even 20 years down the road. Why would you do that? Because by waiting, you get a much, much higher payout later on. People call it longevity insurance. It's a way to make sure you have a safety net of income waiting for you in your 80s and 90s, just in case. This chart does a fantastic job of pulling everything together. Look at the primary goal. MYGA is for safe growth. FIA is for protected growth. And the SPI, that's all about immediate income. And that goal directly impacts everything else. Look at growth potential. It goes from moderate to capped to basically none for the SPI because it's just an income machine. And pay close attention to that liquidity row. The growth products give you some access, but that SPI is illiquid. That's a huge trade-off we need to talk more about.
Okay, let's be real for a second. There's no such thing as a perfect financial product, and it is so important to understand both sides of the story. So let's dig into the core trade-offs you're making with a fixed annuity. Here it is, plain and simple. What you're gaining is huge. Safety, stability, guarantees you can literally take to the bank. What you're giving up is the potential for those really high returns you might see in the stock market. And you're also giving up having access to all of your money whenever you want. It's that classic tug of war between security and opportunity. And we have to be crystal clear about the risks. Number one, inflation. A fixed payment that sounds great today might not buy as much 20 years from now. Number two, liquidity. If you need to pull out a big chunk of your money early, usually more than 10% a year, you're going to get hit with some pretty hefty penalties called surrender charges. And finally, remember that the guarantee is only as good as the company that writes the check. So after all of that, the million-dollar question: how do you know if a fixed annuity actually makes any sense for you? Let's run through a quick little litmus test. The person this is often perfect for is someone who's getting close to retirement or is already there. Their mindset has shifted. They're not trying to hit home runs anymore. They're just trying to protect their base. If the thought of losing a chunk of your nest egg in the market genuinely keeps you up at night, this might be a great fit for a piece of your portfolio. On the flip side, who should probably steer clear? Well, if you're young and you've got decades to let your money grow, or if you're comfortable with market risk to get higher returns, this probably isn't for you. And if you absolutely need to keep your money liquid, where you can get to all of it at a moment's notice, then a fixed annuity just isn't the right tool for the job. I think this quote from our source material really just nails it. A fixed annuity isn't meant to be your entire retirement plan. It's not the whole house, but it can be an incredibly solid, reliable cornerstone for that house, especially at that stage in life when just preserving what you have becomes way more important than swinging for the fences. So we'll leave you with this one question to really think about. As you look at your own financial future, what's more important to you right now? The potential for a higher return or the predictability of a guaranteed result? Your answer to that question will tell you almost everything you need to know about whether a fixed annuity has a place in your plans. Thanks so much for joining me.